Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or go to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much discuss it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personal financial advice, well, just request your wealth analysis today from my team by going to www.yourwealthanalysis.com. With me in the studio today is Mr. David Franson. David, thank you for being here today.
Yeah, you're welcome.
Now, David will be reading your questions, which you have submitted, and I'll do my best to answer them. You can send your questions in right now or anytime during the week. Just save this number. Save it right now. 913-363-1234. That's 913-363-1234. Or you can email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, how should self-employed people save for retirement? For example, should we fund SEP-IRAs, simple IRAs? It's a bit confusing, at least for me.
All right. Instead of making this a tax planning course, I don't want to... let me give you a high-level example.
Okay.
Instead of looking at first SEP, simple, all these different plans and how to structure getting money into qualified accounts, which is helpful, first you need to understand when do you want to retire, and then how much income will you need before you turn 59 and a half. So if you want to retire before 59 and a half, you're going to need some assets that are not in qualified accounts. This is often missed. I've spoken with 45 to 50-year-olds who say, I'm going to retire next year. And I'll say, how are you going to do it? They say, well, everything's in my 401k.
Oh, boy.
And I say, well, you're going to pay a huge penalty to take out those funds right now.
Yeah.
And then we have to work out how to incorporate things like the rule of 55 and other ways to slowly get funds out of the 401k when they retire. So the first step is to first put that lifestyle plan together and figure out how much do you need in the non-qualified bucket. So non-qualified, your brokerage account, for example. And then how much goes into the investment side, so longer term investments, how much goes into your reservoir, so like CDs or treasuries or maybe cash value life insurance as well. Basically, just a way that you can pull income out of a principal protected source in case the markets were to go down during this period of time. And then the rest of it can focus more towards the qualified assets that you can touch once you're 59 and a half. Are you with me so far, David?
Yep.
Post 59 and a half, that's where you're talking here. Here's the gist of it. SEP-IRAs, or Simple Employment Pension IRAs, is what SEP means, is, in my opinion, really for the self-employed person. Think like a 1099 employee, whether you're a contractor with your own entity, maybe you're just your own business, your own LLC, your own sole proprietor, whatever it is, and you're making less than $264,000 in gross revenue, and that number will come up in just a second as to why, but it's less income than that amount. You can contribute up to 25% of your compensation, so how much you're paying yourself, and you need to do this correctly. So find an accountant, find a CPA or an enrolled agent that can help you with this, but you can contribute up to 25% of your compensation, or up to, as of 2024, I believe it's $66,000 is the maximum you could contribute, but it's up to 25% or $66,000 or so, whichever is less. So if you're making $100,000, you can't put $66K in your SEP, because 25% of $100,000 is $25,000. That's the maximum you could do. But it's a way that an individual person can just create a very simple, low cost, easy way to put funds in there for the self-employed, the 1099 situation. Now, all that said, I also want to just say this. I really like SEPs because you could open up a SEP and work with a money manager like me and use like our models, for example, to grow it, instead of the very rigid 401k model of, well, you can buy these mutual funds, these ETFs and hold. Passive investments in qualified accounts bug me, because I believe you can do more if you're actively managing it and you've got a model that has a good track record.
Yes.
So SEPs enable that. They allow that. For all the self-employed people out there, the people running your business, call us about what more could be done. This is a really cool situation. Now, that's the SEP IRA, okay? The KOG, and I never actually knew how to say it, the KOG, KEOGH plan, nicknamed HR-10 plan, is also for self-employed people or unincorporated businesses, sole proprietors, partnerships, whatever it might be. That's really defined for the higher income person. So they still have the same situation, 25% of compensation or 66,000, whichever is less. But based on how you structure your compensation afterwards, you might be able to get a little bit more out in different situations. The code plan is much more complicated because you've got to start bringing in actuarial projections on how you're going to take the income and what you're going to do with it. So, as a general rule, I just recommend you stick with the SEP unless you want to actively work with a CPA who can help you set up and maintain the code plan.
Mm.
And then you've got the simple IRA. The simple IRA is really a 401k simplified. So think of it that way. 401k simplified is the simple IRA for small businesses with 100 employees or less. In this situation, employees can contribute up to a certain amount. There's some cool things with employer and employee contributions in there, but it's really just a simple low fee way for smaller businesses to offer benefits, retirement benefits, without going into the higher cost 401k space.
Yeah, 401ks require a lot more. What makes them more expensive than a simple?
Well, there's more, I don't want to say necessarily regulations, but administrative costs, bookkeeping, kind of how it's structured, all the reporting.
Like some kind of compliance and record keeping, et cetera, et cetera.
It just requires more.
Yeah.
So they made it simple for a certain group, which if you're a business owner with 100 employees or less, maybe it's a good situation for you.
Yeah.
Maybe you go with the 401k route, though. You need to compare the two, but I want to just give definitions to what is out there.
All right.
So, I mean, basically, SEP's good for self-employed people that are making 264,000 or less. And that number will change as the limits change over time.
Right.
The COG, probably for higher income earners that are self-employed or have partnerships in very specific situations. The simple for small business owners that want to offer a benefit but not have as much cost associated with it. And then you got the 401k, which is for the private sector. And then, the 403bs, the 457s, all that. Those are different. We're talking just the private sector here and what the options could be. And really, here's where my mind goes. Let's say you're a small business, or let's just say you're self-employed.
Okay.
You're self-employed and you're thinking, which way should I go? Put your plan together first. How much income do you expect to make? How much do you want to save? And how much do you want to receive when you retire? What does it mean to retire on time for you? Some people don't want to retire at 60 years old because their work gives them purpose. So you've got to define your plan, which a plan really is, what do you want to happen? Then you start looking at the strategies that are in there. So if you want to retire earlier, before 59 and a half, maybe you don't save a ton of money in an IRA. Maybe you need to focus more on the non-qualified because you've already saved enough in the SEP IRA. These are the kind of balanced questions that need to be assessed as you're working. Are you maximizing your Roth? Anyway, we could talk for hours on this, but to understand how much goes where really requires a plan first, so you have context on how much should go into each tax bucket. Each tax bucket would be defined, in my opinion, as, and I try to keep it simple, as qualified pre-tax, which is like an IRA. So it's before taxes, it goes in there, it grows tax-free, but when the money comes out, you pay income taxes. Qualified after tax, like your Roth, so you've already paid the taxes, it's in a qualified account, it grows tax-free, and you can take funds out tax-free. And then non-qualified, which means it doesn't qualify for retirement benefit. So it basically grows, but you pay taxes on capital gains tax on the gains, whether that's short-term or long-term. But unless you can really give meaning and say, I'm doing this for this reason, unless you can articulate these assets are in these places and these accounts for X, Y, Z, it's really hard to decide which way you want to go, in my opinion. You could just say, well, I'm self-employed, I'll just defer to the SEP, but then how much should you put in the SEP? How much should you keep in after tax? Do you need life insurance for business purposes? And does it make more sense to do term? Does it make more sense to do permanent? This is where the comprehensive planning really comes into play on how you can find efficiencies to potentially get more out of your hard-earned money. Your cash flow, especially as a business owner, matters. So you want to make sure it goes to the right places. If you're a small business owner, self-employed, thinking about being self-employed, or just exploring how to fund qualified accounts correctly. Let's say you work for a major company and you're wondering how much did you put in your 401k after tax and how you want to set up for retirement, how you want to prepare for retirement. I want you to text analysis, that keyword analysis, to 913-363-1234 or go to www.yourwealthanalysis.com today. And here's what's going to happen. You fill out some basic information so I understand kind of what you're looking for. You're going to define the relationship you're looking for, whether it's DIY, whether that's a collaborative relationship, whether that's a comprehensive relationship. We figure out your lifestyle and legacy goals in the 30-minute call, and then I run the analysis to show you what could be done so we can explore your lifestyle and legacy potential, so we can show you how to potentially get more out of your hard-earned money. These little efficiencies can make a huge difference overall in your quality of life. And all you got to do is just text analysis right now to 913-363-1234 or go to www.yourwealthanalysis.com to learn more and get started. Doesn't cost you a dime, but really could make a difference. Go there today, and we'll talk soon. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.